Hello, everybody, and welcome to the Investor Roundtable here with F Street. You've got Nick Jung.
And Josh Lurie.
Today, we're excited to bring industrial deals back. We have two excellent opportunities we're going to be releasing here in the next 24 hours, and wanted to go through the opportunities, talk about what we've been doing, what we are doing, and some of the exciting opportunities beyond these that we'll be seeing over the next few weeks as well.
Yeah, so just a little bit about F Street if you haven't joined these roundtables. We are a alternative real estate investment fund. We're focused on the investor, right? Building long-term wealth as well as cash flow for our investor group. We're really focused on the multifamily and industrial asset classes, both value-add acquisitions and ground-up developments. We are, we're an investor-focused firm. We've been in business for over 15 years and continue to grow our portfolio. And we have a great investment community and growing. So excited about speaking with you guys today.
And as we go through it today, we'll talk about our portfolio. And please, we actually want to make this interactive. So if anyone has any questions, we can see them live. We can walk through them. We want to make sure if you have questions as we go through it, you've got Josh and myself to answer those questions and hopefully make sure everybody's comfortable with any of the investments we have going forward.
Yeah.
So talking a little bit about our industrial portfolio, because we are going through industrial assets today. Our current portfolio has just over 3.2 million square feet, right around just about 250 million in assets. This year, we've really done a big focus on seeing the value in these assets, and we'll go into what we've been targeting, what we are targeting, and what we're seeing as a really good value plays going forward.
Absolutely. Yep, we already mentioned ourselves, principal at F Street, work on the investor relations side of the business, and also general counsel. I had the pleasure of going to law school with Nick several years ago at Marquette. So we kind of have a co-general counsel position here as well.
Yeah, absolutely. Yeah, I guess I'll let you walk through it.
Yeah, so just a little bit about, as Nick mentioned, just general things that we're looking for in the industrial acquisition space. And our goal is always to have a path to create value, right? We're not buying deals that we don't have the ability to do that through re-tenanting, releasing. So our goal, we're targeting assets that are built before 2000. So class B- to A- acquisitions. 100,000 plus square feet, and we're looking at markets with low vacancy, with very good velocity, and ability to buy buildings, right, where we can restructure leases. Maybe it's a gross lease that we're converting to a triple net lease to make it more advantageous for us as a building owner. Maybe we're buying assets with incredibly strong below market basis in the acquisition side, where we have a pathway to upside through a re-tenanting. We will buy fully vacant or partially vacant buildings. We'll buy buildings with a mark-to-market thesis, meaning a tenant might be paying $3 a square foot, but their lease expires in 1 year. We know we have that cash flow for 1 year, but we know whether they stay or leave, we have the ability to renegotiate with that tenant to achieve, call it $3.50 a foot or $4 a square foot. So when we say value add, that's what we're targeting, all those different asset classes. And then on the tenant side of the business, we're looking at, obviously, the stronger the tenant, the more likely they're willing to pay. So the credit of that tenant, we're looking at a lot of different qualitative factors, whether they've injected capital into the building, whether they're a manufacturing business, which makes it maybe more likely for them to leave that building. And that's really the goal. Maybe they have a need to expand within the building or expand down the street. All these different things we're constantly evaluating as a team, which makes these investments more or less compelling.
Yeah, absolutely. And that's what we want to go through today specifically is we have two opportunities we're going to be releasing very, very soon here, likely in the next 24 hours, that we want to go through with you that really fit into our thesis, fit into a great long-term strategy for us, and great yields for our investors. Specifically going into why invest. So kind of the first deal we wanted to go through is a sale leaseback deal we're acquiring in the state of Wisconsin. The deal is approximately 185,000 square foot building with great cash flow. It's a 20-year sale leaseback. So we look at it as this is a business that's been operating at this site for over 40 years, is a now private equity owned, vertically integrated business that's going to continue to grow and continue to grow their balance sheet, continue to grow at this mission critical location, which creates one great long-term cash flow. We're essentially buying the project that we'll call a 9% capitalization rate, just over it, with with levering the project, that's going to create over a 9% cash on cash return over the first, really over the first year, then over 10% average over the first 3 years. So specifically, this investment opportunity is called F Street PDC LLC. As mentioned, the project is located in Crawford County, Wisconsin. Due to the actual confidentiality of this, we won't specifically go into the building itself. That's going to be available in the investment packet, which is really why we love this opportunity. Is, it's an off-market opportunity that we're currently at with a sale leaseback, creating that 20-year advantage that will go through more specifically into the packet itself. So that's the great part. With the 20 years, we're essentially seeing 20 years of an asset with 2.5% rent bumps. So those will continue to increase over the ownership of the property, creating good, strong cash flow up front, and then continuing to grow through the asset. Go ahead.
Sorry, yeah, the other nice thing I just want to mention, it's an absolute net lease structure, meaning tenant is responsible for all, not only customary triple net expenses, but all capital improvements of the building. This is really a bond type structure. And depending on our hold period, depending on when we can exit, due to the long-term nature of that lease over 20 years, we might be able to exit this in 7 to 10 years with significant term on that lease and also produce really nice cash flow. Or if interest rates drop, another execution might be a refinance, right? Lower, reducing our interest rate, increasing our cash flow, and getting some liquidity back to our investors before an eventual sale. So we have a lot of options here, but I think based on the 20-year nature, absolute net lease structure, mission critical site, we're really excited about the opportunity.
Absolutely. And we love that the way they're structuring this is to grow the business and to integrate it fully with other very similar locations that have it so they can go from start to finish on these products. So we really like the site. I mean, as Josh mentioned, kind of going over the project itself, total acquisition cost for us is $6.85 million, which we'll be raising approximately $2.4 million of equity. Total project cost being just over $7.185 million. We will lever the project. We already have a term sheet from a lender and are moving forward with that piece of it. So that's just going over the investment structure itself.
Yeah, just if you've joined us before, traditional investment structure here, all investors earn a 7% preferred return at all times on their outstanding capital. That's paid first, and 100% of free cash flow goes back to the investors. So that happens in this scenario. If we held the asset, all pref and 100% of the capital would be paid back in 12 years. And then after that, it splits 50-50, all cash flow and sale proceeds between Class A and Class B. So that's how we currently have the deal structured.
And as Josh mentioned, so just really like an example of the cash flow on this project. As mentioned, we'll be seeing over 9% cash on cash in the first year. Based on the absolute net, there's going to be no other expenses going in, so we have a really good idea of where the cash flow is, where our current debt is, where we're levering that piece of it. Like Josh said, if we kept the current debt, current interest rate, investors will be fully paid back in 12 years while achieving their preferred return during that time period, and averaging over those 12 years almost a 13% cash on cash yield. That being said, what we typically like to do for our investors is try to find that sweet spot where either we'll see a compression in capitalization rates and target a sale anywhere from 5 to 10 years from now, or recap. So refinance the loan, find a really good position where we can turn all the investor equity and then continue to cash flow it with what we call money trees, where you have 100% of your capital back, you've received your preferred return, and now you still have that interest in the property and will still be receiving that cash flow.
Right. And I was going to mention that, at no point in time our investors bought out. They're always maintaining that equity position in the asset in perpetuity, even if we're able to return all the capital, prior to a sale, which is great.
Kind of as an example, This is just us showing a 7-year hold on this specific asset. So, what we see 9.38% year one, and then increasing to over 10% in year 3. And then by year 7, because we're likely targeting a fixed rate with our lender anywhere from 3 to 7 years. We're creating that optionality. As everyone can see right now, market is very volatile, but we know the rate's going to fall in essentially the low 6% range. But this would assume a year 7 sale. I mean, then you'd be returning all of your equity on top of receiving over 10% annualized for the prior 6 years.
And in the investment packet, there's a really good graphic that shows kind of a sensitivity analysis on, hey, what happens if we sell it in year 3, 5, 7, 10, what that does to your equity multiple, what that does to the investment. And as you know, as Nick mentioned, we have some optionality here,
Right.
depending on our debt. Do we want to recapitalize the deal? Do we want to sell it with significant term on the lease? So over the whole period, we were constantly as a team evaluating our options and ultimately looking to just execute to optimize or maximize returns for the investors.
Absolutely. So timing for this project, we'll likely be closing the asset at the end of July. So as mentioned, we'll likely be releasing here in the next 24 hours and looking to have all of the equity in by the middle of July to the end of the July to close on the asset on July 31st. One thing we did want to mention, kind of going back to this, we have seen obviously a ton of interest in our investments lately. A lot of really strong interest, fast investments for great opportunities. And if you are interested, go to fstreet.com, fill out your subscription agreement, because that's really the only and best way to truly reserve a spot in investing in the projects.
Okay, we covered Prairie du Chien, which will be released. Now we're going to move on to the next deal, which we're really excited about. Been working on it for several months here, getting through our due diligence, and it is a 2-building portfolio in Hot Springs, Arkansas. We're excited about this deal. Number one, there's a great strong tenant in the building. It's a water business owned by a large corporation, great tenant, and they are under market rent in the building, but they still have term for another 22 months. So strong cash on cash out of the gates. Yep, strong cash on cash out of the gates. On the single tenant, it's a triple net lease deal. We're buying it for $48 per square foot, which based on our comp set and analysis, we're buying it for a very good value. It's in a really well situated commerce industrial park with great ingress and egress to the highway. And it's a supply constrained market. There's a rocky hilly terrain in Hot Springs. There's not a lot of buildable land. And as you'll see some graphics in the investment packet, it's in a really robust commerce park with limited opportunities to lease. So low vacancy, good location, good triple net lease structure on the main facility. And then the seller is actually leasing back the second building, which is only 6,000 square feet on an absolute net lease structure where they're responsible for all traditional triple net lease, triple net expenses, as well as all capital improvements and replacements to the property. So, and they have a 5-year lease on that.
Yeah, absolutely. But really the value we see here is, we talked about, we're getting the building at a really good basis at $48 a square foot. The main large building, the 80,000 square foot building, was actually recently built. It was built specifically for the water company, which again is a $10 billion company, publicly traded, built only 5 years ago. So great building, will last a much long time with obviously minimal expenses, especially on a triple net lease.
Absolutely.
And their leases are below market. So that's something we'll go through more. Where we see the value here is, there's only 22 months left on the lease at the time of acquisition, but we see a large mark-to-market opportunity. They're about 20% below market. So whether we renew with that company, otherwise we go out to market in the next 12 months, we see a huge value creation at that mark-to-market rent.
Absolutely. And just going back to the initial slide of what deals we're targeting, I mean, this fits our investment thesis and criteria, right? As exactly what Nick said, we have this mark-to-market thesis here. After this 22 months, the current tenant does not have any options to renew that lease, which is advantageous for us. So we would love to keep that water company in the building. They're a great tenant, great user, and they're limited places to go. So that's our opportunity to negotiate with them, negotiating and working with them to get to that higher lease rate, call it 15 to 30%, above what they're paying right now, which allows us to increase the value of the building, pull out some capital, or look to sell the building, right? So maintaining optionality there in terms of refinance or sale decision once we secure them for a longer period of time.
Yeah, absolutely. So love this asset. Josh already went through and we already talked about it a little bit. Obviously mentioned newer facility, total of 86,000 square feet between the two buildings, the larger building being 80,000 and a smaller building being around 6,000 square feet. Like we talked about, there really is very limited space in Hot Springs. It's a strong industrial market with great old operating businesses. That being said, it's really hard to build new and to build efficiently, which
and
is
for the cost we're buying this building for, right?
Exactly. We're buying well below replacement costs, and you can't really build anymore in the industrial park. If we go to a map of the site, it isn't an industrial park, and there's really no room to grow in it, like Josh said, due to the terrain. So we can really see some great value opportunities here with really no new supply coming to the market, and still large, strong needs by not only our current tenant, but other companies in the area.
Definitely.
So as mentioned, the larger building is a triple net lease. It's not an absolute net lease, but landlord responsibilities here are really just structure, which is a brand new structure. So very, very, very minimal with 2.5% escalators. One of the big ones, we actually have a huge rent bump in well, essentially month 10. So that also creates value. But really, we talked about the structure here. We'll see the value is those mark-to-market rents in 3 years, where our goal will be then to either recap out the investors and get your money back, or to really cash flow at a much higher rate in that time period.
Definitely. All right, moving on. Sources and uses here, you can see raising about $1.6 million of equity. We have a term sheet, which we'll talk a little bit, Nick and I, about the debt execution and why we're executing on the debt the way we are for this specific business investment thesis. Purchase price, you can obviously see that makes up the majority of it. And then we have other costs that we always disclose that are part of the deal. So total sources and uses are $4.2 million. And we're all in for about $48 a foot.
Right. So the debt structure we're structuring here, we're really being very specific to optimize the debt for the asset. So what we're structuring is, as mentioned, there's about 22 months left on the lease when we buy the asset for the large building. The smaller building has 5 years. It's a 5-year deal that'll actually start the day we buy the property, and likely that tenant will stay there long term. That being said, knowing that we are potentially going to have vacancy, we want to mitigate any risks potentially for our investors and have enough reserves. So we actually, as part of our S&Us up front, we actually have over $200,000 in reserves, which would cover just over 18 months of essentially vacancy in the event we needed to backfill the building or we didn't find a tenant. We are confident based on supply constraints in the market that we would, but we're being very conservative. So in the event we renegotiate with the tenant, which we're going to start those conversations immediately upon acquisition, or they're not going to renew, we know we can start marketing that. Then it's going to all be returned to our investors. So it's a great way for us to have that reserved up front and capitalize it up front to make sure that we don't have to contribute or do capital calls for the property in the future.
Definitely. And also allows us to be prepared for any commissions on a new lease, any tenant improvement dollars, which would be fairly minimal, but we don't know who that next user might be. Now, our goal is to keep the user and negotiate with them, right? But we always are planning for different scenarios. So that's why this reserve is built in prudently to help mitigate risk. And we have the cash available to look forward to that, potentially what that next tenant would look like and what that deal looks like.
Absolutely. And that's where with the debt as well, the way we're structuring on the $2.625 million is the way we're structuring is a 3-year deal where the first 24 months were fixed. And the third year, we have the optionality to go interest only. So in the event we didn't have a tenant and we need to be flexible, we can shift that to interest only, knowing we're flexible and can minimize interest costs during that time period. Definitely. In the event of vacancy.
Yep. Yeah, so just back to the investment structure, I'll just run through it quickly. It's the same as the other deal. This is a pretty traditional deal structure for us, paying a preferred return on equity of 7%. And then 100% of the cash flow goes back to the investors until their capital is back. On this deal, that might happen in the first 24 months, depending on what that next deal looks like. If we are able to achieve that mark-to-market thesis that Nick talked about and create that value, we'll be able to pull cash out of the deal, return it, continue cash flow, or we can sell that based on a number of variables that we'll evaluate, the term of that next lease, the economics, et cetera. So once that happens, then the same splits are in place as the prior deal.
Absolutely. So wanted to just talk through the specific cash flow here. So on this deal specifically, the deal we talked about earlier, F Street PDC LLC, that's targeting more of the cash flow. You're going to see more cash flow up front. Here we're targeting really more of that, as we mentioned earlier, that return of capital on a shorter period, targeting that mark-to-market rents. So here we're upfront in the first year, cash on cash based on the current leases is just over 8% at 8.24%. In year 2, I did mention there are rent bumps for both the master lease and the main tenant. So that increases to just over 10. And then we're assuming sometime in year 3, whether we're getting a new tenant, we're renewing with the current tenant, we'll see a much larger capital event where we're targeting returning 100% of that capital. And a deal like this, we push to a higher IRR. I mean, we exceed, and we'll see it in the investment packet, over 100% IRR on the project. So a little bit of a different structure than the first deal we talked about. But again, more of a short-term value play rather than a long-term cash flow play.
Yeah, and this event right here, this shows a capital event, refinance to return the capital and stay in the deal. We might also say, as I mentioned, depending on the economics of what that new lease would look like with the current tenant or a new tenant, we might want to sell here. So this is showing a capital event based on the current lease of 22 months on the main building. And then this is what cash flow looks like after that, but you have all your capital back at this point in time, and now you've planted that money tree, and cash flow is being milled monthly with 100% of that capital back.
Exactly. So talking about critical dates on this project, very similar. So F Street Hot Springs LLC, very similar to F Street PDC LLC, where we're targeting closing in the first 2 weeks of August rather than the end of July. Likely call funds at the end of July, first week of August, and close on approximately August 8th. For both of these investments, our minimum investment is $50,000. As mentioned, these will likely fill up very quickly, just based on what we've seen from our investors and what our investors have been looking for, and both of these deals falling really well into our investment thesis with these industrial.
Yeah, I think we're ultimately very excited about both for the reasons that we've explained. First one, obviously, great cash flow, 20-year term, little friction. It's essentially a bond paying really nice cash on cash in a strategic location, right? Second deal, that opportunity to mark-to-market leases, being able to get to the refinance and provide liquidity back in a short period of time. In a great commerce park in Arkansas, or get to a sale. So as we mentioned, we're excited about both opportunities here. Excited to chat with investors, and if you need anything from our team, our investor relations team will be in touch with you. Please feel free to ask any questions now or later today. Thank you all for your time. I think we're done.
Yeah, I mean, the only other we did want to mention that we have more opportunities coming up over the next, call it 30 to 60 days. We have multiple properties we're currently negotiating LOIs on, or we actually have under contract that we're currently working through the due diligence on. So want to keep everybody aware of that, all falling with our thesis. Again, we see multiple deals on a daily basis, and we're very selective on the ones we wanted to really fit within what we've talked about. Our target, either low basis, mark-to-market rents, strong long-term cash flow for our investors. So lots of opportunities coming up. Always available for questions. You can always reach out to Josh or myself or anybody on our investor relations team. Wanted to confirm if there's any questions at this point. It looks like we have a few. And again, if you have more questions, let us know or feel free to reach out after as well.
Thank you, everybody, for your time. We appreciate you joining. Yeah, so the minimum investment for the deal, that was the question. Each deal is a $50,000 minimum investment, excuse me. If you want to log on to our portal at fstreet.com, you're able to do that to sign all documents to become an investor. If you have any questions, our investor relations team is happy to jump on a call to walk you through anything to make the process simple.
Yeah, there's a good question. So there's a question about if you have investment in the PDF, which is the private debt fund that F Street Investments offers as well. For any investor that is in the private debt fund, we can, after you hit that 1 year period, we can move funds from the private debt fund into any specific investments. It's a great question.
Yeah, the question is, what does IRR stand for? That IRR stands for internal rate of return. It's a financial metric that we use carefully here, along with many other financial metrics to evaluate an opportunity. But essentially, it is all of the cash flows in the deal from the time that we buy the asset to the time we sell the asset, discounted back. So the present value today of all the future cash flows. And that's an annualized return. So if we're projecting a 15 or 18% IRR over the, for example, 5-year hold period, when we buy it to when we sell it, that's each year what our projected or estimated IRR is going to be. Now that takes into account, like I said, all the cash flow, but also what that exit sale is, right? Based on different assumptions that are market driven. What cap rate do we sell it at? And I would say it's an art, not a science, but it's also calculated and market driven.
The question is there a determined hold period for Hot Springs? There is not. As mentioned, we'll target with the current lease expiring in month 22, that's really, again, where we see the value in the asset is releasing that or extending the lease with the current tenant. And we'll evaluate that in month, call it 22. In the event we have an extension where we have a new tenant in year two, as mentioned, we might evaluate a sale. I think our target hold period for the Hot Springs asset is a 5 to 7 year period, knowing we'll likely get a renewal in year two or we'll get a new tenant in year two, and then likely refinancing, cash flowing, and then eventually looking for a sale sometime during that period. As mentioned, we always try to target what we think is going to be best for investors on a target exit. And I think for a deal like this, that's typically what we're going to target is somewhere in that 5 to 7 year period.
Yeah, yeah, and part of, we don't have the crystal ball in terms of what the economics of that new lease is going to be. That's part of that negotiation with that tenant. So depending on if they set what term or what rate, what the economics look like, we'll be able to potentially pull all the capital back, or we could just go right to a sale, meaning that we've created a lot of value at a higher lease and driven value to the project. So as Nick mentioned, and our underlying thesis here is we like to maintain optionality, but at the same time need to be respectful to the investment community where we can execute within a call it 5 to 7 year hold period.
Yeah. So the question was, could you do a comparison on like a fact sheet of it, like the deal by deal? We'll do a really quick run through on that specifically. But again, you can reach out to the IRR team and we can put that together very specifically for any of our investors. And you can put those side by side on the investor packet. Specifically, F Street PDC LLC. That investment, as mentioned, is a 20-year sale leaseback and a long-term cash flow. There, during the first 3 years, you're just going to see stable ongoing cash flow increasing at 2.5%. So the beauty of that deal is over a 10% cash on cash over the first 2 years, increasing to 11% thereafter, and then increasing 2.5% going forward. We're doing a longer term debt there. What we talked about there is that's just longer term cash flow, and then we'll returning that capital and call it somewhere between year 7 and 12. Or again, if we see a compression in capitalization rates, maybe that's an exit again. The Hot Springs deal, again, it's really more of a value add deal. We look at that deal as year one cash flow isn't as strong as F Street PDC is, but it will be increasing and likely increase into more of a capital specific event in the first 3 years.
And the mark-to-market thesis, which is why we're targeting that opportunity and the location, obviously, that's the opportunity to drive value to allow us to either refinance or sell that asset in a short period of time to provide liquidity back to the investors.
Yeah, so we see them as both as excellent opportunities. We really like both opportunities. They just each have a different thesis behind them, falling generally under the F Street industrial acquisition thesis.
Yeah, good question. The question is regarding depreciation benefits that flow through to you guys, the investors, and the answer is yes. We've actually have been working with our third-party cost segregation team at Whitfleet, and they've provided benefit studies that are usually very accurate, and we have those included in the investment packets to forecast what your depreciation benefits would be on each asset. So those are included in the investment packet. If you have any questions regarding that and how that impacts you, we are happy to hop on a call, and our IR team is always available to hop on a call as well.
Yeah, and both these specific projects, we would be completing those in the first year, so those would be applicable for 2025.
Correct.
Great question. So do we see any tariffs affecting either of these properties? I think the beauty is, especially the one in Wisconsin, F Street PDC LLC, as mentioned, that's a vertically integrated company, all manufactured and done here in the United States.
Yep.
They're all based in Southwest Wisconsin and Eastern Minnesota. So I think they're actually, I'd call it tariff proof. So they're actually going to take more advantage of the tariffs because they're in an industry that's importing a lot from other countries, but they're all locally here in the United States.
One of the reasons why we're drawn and excited about the opportunity, right? It's a single tenant deal, so the risk is inherently in the tenant and the quality and strength of that tenant. So
right.
that's a real advantage of the opportunity.
Absolutely, and the private equity ownership and the fact that private equity wants to come in and acquire this asset to grow the business and to continue to grow it, they likely see it as a strategic advantage, probably due to those tariffs as well.
And having a stronger operator here the private equity business, right, who has extreme knowledge in this industry, is another huge advantage of the opportunity why we like it. So
Yeah, absolutely. And then Hot Springs, similar. It's a U.S. manufacturer of the water business. I mean, I think, one of the largest. They're a $10 billion water company. This is one of the subsidiaries for that entity and manufactured here in the United States. So again, I think a lot of these businesses actually really will be able to take advantage of the tariffs. And again, another reason why we like it is not likely to be affected by any tariffs or potential concerns with tariffs.
for sure. Yeah, it's a good question. The question is regarding the capital structure of the deal and what happens after investors have 100% of their capital back. And the Class A investors maintain their equity in the asset forever until we sell it. They receive 50% of all cash flow, all refinance proceeds, all sale proceeds in perpetuity until that final sale. I think that answers the question.
Yeah, I mean, so to kind of go more further, so when an investor invests with us, why we call it money trees, once you have 100% of that capital back, you're still a 50% owner in the project. So you'd be receiving 50% of all cash flows, even after your money and preferred return are paid back, including a sale. So a good example would be if I use the cash flow from F Street Hot Springs. Our example that we're using here on the 100K investment is an investor would be receiving, if you invested $100,000, you'd receive your 8,200 and then 10,000, and then a refinance where you're receiving 107,000. So you'd have 100% of your investment back plus your 7% preferred return. In year 4, you have 100% of your equity back, and you're now receiving $4,600 is our estimate there. And then we're assuming in year 5, a sale, you're still receiving 50% of cash flow. So there'd be an additional capital event there. In the event we didn't sell in year 5, there'd be still additional, call it this number, increasing at whatever number it is. So, yeah, great question. That's the way we look at it, why we call it money trees, is for our investors, you're in it with us forever. We don't buy out our investors. We look at it as a long-term play for our investors.
And the nice part is once you have the liquidity back, you can go and make another investment, whether that's with us or with any sponsor. And then you're still earning money from that deal, as Nick said, until we hold it. Until we sell it.
Good question. Yeah. So, what do you do if the property sits vacant? So, like, use Hot Springs as an example. Absolutely. I think that's something we measure into it. We completely understand that properties could stay vacant, and 100% that does happen. One of the things we really liked about the Hot Springs market is how massively supply constrained it is. So, as mentioned, we have almost 2 years of carry in there in the event of a vacancy. So we account for that up front. And we wanted to make sure we did that in the event there is vacancy and we're unable to backfill it immediately. We have that covered for that period. Otherwise, historically on projects where we have seen an inability to fill a vacant building, F Street has been covering that as the principals to ensure that it's still a long-term successful investment.
Yeah, I would say that's part of the risk and part of the opportunity specifically, right? We underwrite that risk. We carry the adequate amount of reserves to mitigate that risk. We try to find markets like this market with low vacancy, with liquidity and tenant demand. And we're also looking at the economics where we're buying it for $48 a square foot, where we can be more competitive than other buildings to attract users, still get deals done with prospective tenants. But ultimately the goal is doing whatever we can to keep the tenant in this location. The building was built for them 4 years. Also it's our diligence, talking to the brokerage community, understanding how long average these types of properties sit on the market for, which informs our underwriting and how much reserves we're building into the project. So it's a risk. We underwrite that risk, but we also know that there's an opportunity, right, to achieve higher rents, higher value. So with risk comes hopefully reward.
Yeah, absolutely. So one other thing we did want to mention is I talked about a little bit earlier. So for the F Street PDC LLC opportunity, again, one of the reasons we really like the opportunity is it's confidential, is it's really value that we're able to talk through with this private equity group. As part of the subscription process for it, there is a non-disclosure agreement we are asking our investors to sign before reviewing it. And again, love the opportunity, love both the opportunities today. And we're really excited about them. And we think they're great that fall into our thesis and to what we think is going to be great for our investors long term.
Absolutely. If there are there any other questions? Okay, so we are at the conclusion of our presentation. There are no more questions. We really appreciate all the really thoughtful questions. It's a great conversation. Hopefully it was helpful. If you have any follow-up questions, please let me, Nick, or our entire team here at F Street know, and we will be responding quickly and being able to be available to answer calls or answer emails, etc. But with that being said, please hop on fstreet.com. Please let us know if you're interested in investing. All of the paperwork will be released in the next 24 hours. And now is the opportunity to invest. We hope to have you involved. And we expect this opportunity to move fast just based on the prior deals and how fast they've raised in the industrial space. So thank you very much. Appreciate your time. Have a great day.
Thank you, everyone.
Thanks.